Recap. I'm Daniel.
And I'm Mira.
So if you open like any standard textbook on economics, it'll tell you that when a country suddenly loses jobs, the stock market is supposed to panic.
Right, yeah. It's supposed to be this fundamental law of financial gravity.
Exactly. But today, the market's physics engine it completely broke. We saw this stunning U.S. jobs report that triggered a massive, basically a bad news is good news rally.
It was wild.
Yeah. Wall Street essentially threw a party for a contracting labor market. They sent the S&P 500 up 1.0% to 7,757.64. And gold absolutely skyrocketed to $4,399 an ounce.
Oh, yeah. It really was a wild day to watch the screens. Investors are celebrating economic weakness because it effectively boxes the Federal Reserve into a corner, right? It's forcing their hand on interest rates.
And that is exactly what we're tearing apart today in this deep dive. So here's what you're getting from today's recap. We're going to unpack the macro setup that led into today, the massive payroll shock that just completely shifted Fed expectations, the latest on the Strait of Hormuz negotiations, and some really major AI infrastructure financing.
But really quickly, before we jump into all that data, we just want to clearly state up front that this deep dive is strictly for market context and discussion. It is not personal investment advice or a recommendation.
Right. Definitely not advice. All right, let's unpack this. Session one.
Yeah.
What set the stage before the U.S. session today? Because if you were sitting at a trading desk heading into Friday morning, the tension was just palpable.
Oh, totally. To really understand the explosion we saw on Friday, you have to look at the pressure cooker that was built up on Thursday, August 6th. Heading into today's session, we had this distinctly hawkish setup from the central bank. You had Federal Reserve Governor Lisa Cook and Fed Chair Kevin Warsh, and they had both struck these very firm, uncompromising tones during their Thursday appearances.
Right. They were explicitly prioritizing sticky inflation over any bubbling concerns about the labor market. They were essentially looking the market in the eye and saying, we are not done, which leaves the door wide open for a September rate hike.
Exactly. And that kind of rhetoric, it creates a highly defensive posture. If you're managing a portfolio, you are bracing for tighter financial conditions. But, and this is where it gets interesting, while the Fed was talking tough in the U.S., we got some really fascinating overnight macro data from overseas that it completely complicated the global picture.
Which data are you looking at?
Let's look at the China trade data. Overnight, Beijing released figures showing their July dollar-denominated exports surged by a massive 23.9% year over year.
Oh, wow.
Yeah, that single month created a $112.5 billion trade surplus.
So if you're listening to this and wondering why a Chinese export number actually matters to the U.S. market, consider this. Is this export surge essentially proof of robust global demand for, say, tech and clean energy components, while internal Chinese consumption just sags? Because, it seems like they're effectively exporting deflation to the rest of the world.
Yeah, I'd actually take that a step further, to be honest. It's not just a sign of robust external demand. It's a symptom of a structural domestic imbalance.
Right.
The export surge was led by industrial products and commodities. But if you look at their imports of key raw materials, like copper, they actually fell over the first 7 months of the year.
Which means they aren't actually consuming what they produce.
Precisely. Domestic industrial demand within China is incredibly weak right now. When a manufacturing powerhouse like China overproduces relative to its own internal consumption, it has no choice but to offload that excess capacity globally.
And to move that much volume, they have to slash prices?
Exactly. So they structurally lower the cost of goods worldwide.
Which is just a massive macroeconomic cross-current for the Fed. On one hand, you've got Kevin Warsh threatening rate hikes to fight U.S. services inflation. But on the other, this wave of cheap Chinese goods is actively driving global goods prices down. And that wasn't the only international factor scrambling the Thursday setup, right? We also saw a major, highly coordinated move in the currency markets overnight.
We did, yeah. The U.S. Treasury and Japan announced a joint agreement to combat speculative currency swings.
Basically signaling intervention.
Exactly. Washington and Tokyo signaled that they won't hesitate to actively intervene in the open market to stop unwarranted weakness in the Japanese yen.
And it worked instantly. Just the mere threat of coordinated intervention forced hedge funds to basically have their net short bets against the yen.
But let's break down the mechanics of that for a second. Why does threatening hedge funds print floor under global markets?
It comes down to how those speculative bets are structured. When funds short the yen, they are essentially borrowing in a cheap currency to buy higher-yielding assets elsewhere.
The classic carry trade. Right, exactly. So when the Treasury and Japan threaten to step in and buy yen, those funds panic. To close their short positions, they have to buy yen back, which drives the currency's value up.
Got it.
This is a textbook example of using FX intervention as a floor for global liquidity. By forcing those speculative short positions to unwind in an orderly way, they effectively stabilize global capital flows before the U.S. stock market even opened.
Okay, so wrapping up session one, the market basically entered Friday morning completely boxed in. You had a hawkish Fed threatening rate hikes, and that was colliding with global cross-currents like Chinese deflation exports and joint FX interventions acting as a liquidity floor. The tension was just immense.
It really was.
But that entire Thursday setup was completely obliterated the second the clock struck 8:30 a.m. Eastern Time on Friday. Which brings us to our next part.
Yes.
We're going to take a quick break, and we'll be right back to cover the day's massive catalysts.
Welcome back. Let's dig into session two. What moved markets during U.S. trading hours?
This is the moment the dam broke. At 8:30 a.m. Eastern Time, we got an absolute blockbuster of a data release. July U.S. non-farm payrolls didn't just miss expectations, the number went negative.
Yeah.
The U.S. economy actually contracted by 23,000 jobs.
Which is just staggering when you consider the forecast was for a gain of 80,000.
Right.
And on top of that, the unemployment rate ticked up to 4.1%.
The moment that data hit the terminals, the narrative instantly shifted to a dynamic we see often. Bad news as a Fed-cut chicken game. Markets immediately looked at that 23,000 job contraction and effectively priced out any further rate hikes from Kevin Warsh and the Fed.
They basically called the central bank's bluff.
Exactly. And the velocity of the market reaction was violent. When we say markets priced out hikes, you can see the exact mechanics of that in the bond market. The 10-year Treasury note futures spiked to an intraday high of 108.94.
Wow.
Now, if you're tracking bond math, remember that when bond futures spike like that, it means traders are panic buying treasuries, which causes the underlying yields to just collapse.
Right. It was a massive repricing of risk. And simultaneously, the U.S. dollar index got absolutely crushed, dropping down to 99.48.
Because if U.S. interest rates are going to fall, the dollar just becomes less attractive to hold compared to other currencies.
Exactly. And if we connect this to the bigger picture, it all comes back to the Fed's dual mandate, right? Price stability and maximum employment. With the unemployment rate ticking up to 4.1% and payrolls actually shrinking, the market is betting the Fed can no longer justify their hawkish Thursday stance just to fight the last mile of inflation.
Right.
The labor market isn't just cooling, it is actively flashing a warning sign.
But of course, you know, in a data-driven world, there is always political spin trying to massage the narrative. White House advisor Kevin Hassett went on the offensive to dismiss the jobs miss. He argued the numbers were distorted by a drop in government workers, and, I mean, this is quite a hangover from the 2026 World Cup.
Yeah, the market completely ignored that spin. I mean, traders don't buy the idea that a soccer tournament hangover causes a negative 23,000 payroll print.
No, they certainly didn't. At the same time, we have to impartially note the mounting political drama surrounding the central bank itself. The Trump administration is proceeding with an attempt to fire Fed Governor Lisa Cook, and that's despite recent setbacks in the Supreme Court. So we are seeing immense tension right now regarding central bank independence.
Which is a critical systemic risk factor. I mean, whenever central bank independence is questioned, it introduces deep rate path uncertainty. If investors believe rates are being set by political pressure rather than economic data, you just lose the foundational trust in the bond market.
Yeah.
But again, the market largely looked past the political drama today. They traded the raw, undeniable math. The economy lost jobs, therefore the Fed must pause.
It's all about the discount rate. But let's pivot from domestic data to the other massive story that moved the tape mid-session, which is the Strait of Hormuz. Headlines hit that the U.S. and Iran, mediated by Oman and Pakistan, are actually nearing a deal to reopen the strait. President Trump signaled that the conflict could end soon, and the U.S. offered to lift the blockade on Iranian ports once commercial shipping resumes.
Yeah, and the importance of this cannot be overstated.
Yeah.
We are talking about a vital global trade choke point.
Huge.
Roughly 1/5 of the world's internationally traded oil and gas flows through that corridor. If this is a durable agreement, it would reverse the recent oil shock, significantly lower global freight costs, and basically boost corporate margins across almost every sector.
Okay, I hear that, but I have to push back a little on the prevailing narrative here. Wall Street often talks about geopolitical events as if they are these unpredictable natural disasters, like a hurricane that just suddenly resolves itself and the sun comes out. But aren't we really just watching geopolitical escalation as game theory brinkmanship?
That is a very fair challenge.
Right. Because neither side actually wants a total economic collapse, but both sides want to maximize their leverage. So are both sides just using tactical pauses to extract concessions? Because let's not forget, Iranian hardliners are still publicly demanding massive sanctions relief and financial compensation before they allow transit.
You're entirely right to view it through a game theoretic lens. It is absolutely brinkmanship.
Yeah.
The market is currently pricing in the optimism of a deal which helped stabilize risk assets midday, but the underlying structural conflict of who actually controls and secures that routing corridor is far from resolved.
Exactly. So, summarizing session 2. That massive collapse in bond yields, triggered by the negative jobs report, combined with the hopes of energy relief from the Hormuz negotiations, essentially gave a green light to risk assets. Tech stocks flew, and the Nasdaq surged 1.3%.
We'll take a quick break here, and then we'll dive right into the corporate news.
All right, moving into session 3. What were the key corporate events and what do we watch next? Because beneath the macroeconomic headlines, the AI money machine was operating at full, unrestricted throttle today.
It really was. Today offered perfect proof that the concept of AI capex as a self-referential valuation loop is still dominating capital markets. We saw 2 massive funding events proving that investors are more than willing to finance the physical infrastructure needed for generative AI.
Let's start with the public debt markets. Alphabet initiated this massive 10-part, $25 billion bond sale on Thursday, and the demand was staggering. They drew an overwhelming $115 billion in order book interest.
Which is wild. If you think about the mechanics of that, it is a phenomenal amount of liquidity chasing corporate debt. What it tells us is that despite recent Wall Street concerns about big tech's free cash flow lagging their massive capital expenditures, the fixed income market is essentially giving them a blank check.
And the private markets matched that exact same appetite. Firmus raised a fully subscribed $2 billion strategic equity round. This was backed by NVIDIA, Coatue, and Blackstone, and the capital is specifically earmarked to build Asia-Pacific AI factories.
Yeah, and this is the exact mechanism of that self-referential valuation loop we always talk about. The capital markets, both public debt buyers and private equity firms, are blindly funding the infrastructure builders. Those builders then use that billions in capital to buy GPUs from companies like NVIDIA, which in turn justifies the massive trillion-dollar valuations of the entire ecosystem.
Right. It's just this highly capitalized, closed loop.
Exactly.
It's a fascinating dynamic. But outside of the AI bubble, we also saw some major trade and regulatory actions hitting very specific sectors today. On the trade front, President Trump signed an executive order imposing a 15% tariff and a minimum import price of 21 won per kilogram on polysilicon.
If you track the clean tech sector, that is a structural earthquake.
It really is.
Polysilicon is the foundational raw material for solar panels and semiconductor manufacturing. Setting a hard price floor of $21 and adding a 15% tariff artificially and structurally increases input costs for U.S. solar manufacturers. It's a direct, unavoidable margin tax on the renewable energy supply chain.
And speaking of margins being attacked, we have to talk about the massive legal blow dealt to Meta. This ruling came down Thursday evening after the market close. A New Mexico court and jury ordered the company to pay $942 million in penalties and abatement funds related to a lawsuit over youth mental health and exploitation. Right. But it wasn't just the financial fine that caught the market's attention. The court mandated a strict 90-hour monthly limit on Facebook and Instagram for teens in the state.
Yeah, the $942 million penalty is basically a rounding error for a company like Meta. But that operational mandated, legally enforced 90-hour monthly usage cap is an unprecedented existential threat.
Absolutely.
The entire premise of their ad monetization model relies on frictionless, infinite user engagement. If other states look at New Mexico and adopt similar caps, it strikes at the very heart of how they generate revenue. It is a major regulatory precedent.
So, if we step back and look at the whole board, today proved that nothing makes Wall Street celebrate a Friday quite like a terrible jobs report that keeps the Fed at bay. With payrolls shrinking by 23,000, the only ones working overtime seem to be the gold bugs who push gold up to a glittering $4,399 an ounce. Meanwhile, That New Mexico court is forcing Meta to set a 90-hour monthly social media limit for teens, which is still about 89 hours more than the Fed spent considering a rate hike today.
That's pretty accurate.
So enjoy the weekend, celebrate the rally, and if your boss asks why you're logging off early, just say you're doing your civic duty to keep next month's hiring numbers down.
That is the perfect summary of a broken physics engine. But looking ahead, here is what you need to watch over the next 24 to 48 hours. First, watch the weekend headline risks regarding the Strait of Hormuz negotiations. Any breakdown or sudden breakthrough will instantly reprice crude oil on Sunday night when futures open. Second, Monday morning brings earnings from Tyson Foods. We'll be parsing their management commentary closely for a real-time read on consumer demand and grocery food costs. Third, Monday afternoon features U.S. Treasury bill options, which will give us a fresh read on near-term funding markets post-payrolls. And finally, keep in mind, it's Japan's Mountain Day holiday on Monday.
Right, which means trading liquidity during Asian and early U.S. hours could be extremely thin, potentially amplifying any sudden yen interventions if the Bank of Japan decides to act again. All right, that wraps our main sessions.